Summer Bears. This is the Viper Report market wrap video for the week ending August 15th. It was a pretty good week for the markets. You can see this rundown led by the Russell up 3%, transports up 2, industrials Dow up 1.74. Even the New York Composite beat out the Nasdaq, which is only up 0.4%, and the S&P, which is up just a little under 1%. So big loser was gold, down 1.8%, but it's still in that trading range we've been discussing for a while. If we flip this and look to the monthly, it looks like a pretty good month. Utilities still in the lead here, and only the transports are lower on a month back basis. Nice gains in the Nasdaq, 3.6 and 3.3% in the S&P 500. Weekly charts continue to look strong. So this is the SPY. Most of them have overcome their monthly R1 resistance as well as the yearly R1s for both the S&P or SPY and the QQQ. You can see this red line is the monthly R1, which was at 642.78. So we closed above that, and you can see next month it's 653.32. Ever since we turned bullish back in here, we've been taking out the monthly, R1 levels on a several month basis. But so today we'll discuss whether there's any changes in that. The AD line still really strong. It's rising, after the pullback 3 weeks ago. It's not yet made a new high. If we look at the daily, we have seen a marginal new high on Wednesday of this week. So, but it's pulled back since then. So we'll get into a little later. Some of the other averages have not, their AD lines have not made new highs. Weekly chart of the Qs also looks pretty good. Formed a doji on a weekly basis, but after the major breakout above the February high, this line A, that becomes initial support, at 541 down to 515. Below we have the AD line, which also made a new high a week ago. Back in the end of April, you can see the AD line broke out to a new high, and that forecasted a new high, also for the QQQs. Right then we were trading about 472, so it was at that point was suggesting we would move above 541, and clearly we had. Stark band up here at 592. We'll look at some of the yearly pivot levels in a few. So my summer bear reference and the headline for this piece is deal with the fact that the bullish percentage dropped pretty sharply last week, and the bearish percentage picked up. You can see that the difference in these two has dropped below the moving average. It was about -7, now at -16. So that's I really was expecting it to go higher, and still am, but the next couple of weeks will tell the difference. Probably the bearishness is partially a result of the fact that the seasonal pattern for September is lousy. You remember last year, or some of you may remember last year, that took prices down into the first week of September, and then it was a short squeeze because everyone had to scramble out of their puts as we rallied. Last September, you can see pretty good movement up, here, and that kicked off the rally into the election. So, it's still looking pretty good. You can see the R1 here, the yearly R1, at 643.44 has been exceeded. R2, 695.50. So whether that'll be exceeded before the end of the year, we'll have to see. You can see the AD line and the breakout, the new high. Everything looks good there. The major 20-week EMAs at 505, which kind of corresponds to the breakout level here. In Friday's contribution to Forbes.com, link is in the video description, I looked at some early signs of a momentum loss in some of the growth stocks. But as I pointed out, it suggests we could get a rest. That could be a sharp pullback. Those are usually the best times before we move higher. Also, we'll go into the seasonal negativity we had talked about, and it's important to look at the relative performance of the various market averages. This chart was in the article. So in green we have the Russell 1000 growth, and here in blue it's the Qs, up 11% I guess at that point, and up 13% roughly for the Qs. S&P down here at about 9%. Okay, Russell 1000 value only up 5%. So if you put all your money in the Russell 100 value, you'd be up a little over 5%. Whereas if you put it in the Qs or the other growth, you had almost double the performance. That makes it really important thing to watch, and that's why I advocate relative performance analysis. It's a current look at the daily 80 line, still clearly positive. You can see we've edged above the R1 for the SPY. Support at 634, which is the 20-day, and then the pivot, which is at 629.15. The R2, is at 653.48. That would not be much of a stretch to make it there. In the next month or so, still would not be surprised to see it drop back towards that pivot or even the 50-day moving average. The drop down to there, that's at 620, would be enough to shift some of the FOMO buying in the past month or so, clear the air. So SBAD line did make a marginal new high last week, still in a trading range. If it drops back below its moving average, then we have to see whether this support level holds. Stocks only has not, so we have this divergence here, so that's something to watch, and could imply a test of this line B. And the NYSE all, of course, includes the bond funds, etc., and it did also make a new high. Looking at the QQQ on a daily basis, we're also above the R1, with the daily Stark band at 588 and then at 604 for the R2. So AD line still above support. RS is declining but still positive. I should have looked at the weekly Qs first. You can see, 0.5% gain. It's closed above the R1 on a yearly basis, which was at 572.08. We took some little profits around this area, and a little bit lower in the part of our position in the Qs, and our entire position in TQQQ has been closed out. 626.93 is the yearly R2, and you can see that in dark blue we have the Stark bands. It's at about 603. If we were to spurt up to 603 before a pullback, I think that'd create probably a short-term selling opportunity. Looking at some of the other measures of the market, health, everything still looks pretty good. You can see we have the VIX, and you can see resistance, these two peaks just above 20, 21, I think. A move above that would be could be the early signs of an uptrend. You want to be aware that you can see we have these spikes, and then it quickly reverses in the past. Same thing for the VXN for the for the Nasdaq 100, and its peak here is about 22. So we monitor those on an ongoing basis, and certainly will let people know if there is a problem. Here's another look at the sentiment picture, how the bullish has really tailed off, is up to 45, now 29. So it shouldn't go a whole lot lower, I wouldn't think. We're still on this huge oversold condition we saw in March, April, and early May, and that typically, once it bottoms, will spur a longer rally than we've seen so far. There was a nice spike in the number of stocks making new highs on the New York Composite. We got up above 200 and more importantly above the early July peak. Still quiet in the new low department, so we would look for a change in that to warn of a more deep correction in the market. We look at the NASDAQ. It usually leads both up and down, and so you can see we got surged well above 400 on Wednesday. And 94 still low, so you can see this peak at around 250. Yeah, that's kind of the benchmark to look at. Looking at the weekly ETF report, will be sent out later today. You can see a bunch of new buy signals: Brazil, Europe, healthcare. So this is the in red there. Why is it red? Because it's closed below the pivot here. You can see the close at 45.86. The pivot's at 49.40. So that's why it's red. The other healthcare ETFs, medical devices, also give a weekly positive signal, but are above their pivots. Global healthcare, medical devices, the small cap PSCH, small healthcare, VCR, consumer discretionary, VGK, which is a Europe ETF, VHD, the Vanguard Healthcare, VHE, the health equipment, as well as XLV and RPV, which is the value. But all that's quite interesting. So we scroll down to the the breakdown. Still a very high level of ETFs, 90.1 now percent above their quarterly pivots. So of course we're going to get new quarterly pivots at the end of September, but that's you can see that over here we have the XLV closed above its quarterly pivot and its weekly. So earlier in the week we put out some buy levels for healthcare, and we'll be monitoring those. If we have to raise them, we have to raise them. But growth still leading based on these 100% above the quarterly pivot, 90% weekly and daily. In the value category, not quite so. It's still 100% overall above the quarterly pivot, but 72% above the weekly, and 63.6% above the daily. You can see the XLF, XOP, VDE, energy, and industrials are all negative on a daily. So if we see a rotation into value out of growth, we'd expect to see these numbers improve. Still short side in the leveraged ETFs is not favored. You can see all red here. The long positions probably got out of our TQQQ position a little early, but it hit our criteria, so we stuck with the plan. The breakdown from the sector table shows you energy still looks weak. Went from 41.7 last week down to 33. A couple of strong moves, particularly in the consumer discretionary. 58.3 to 83.3. That suggests that everyone's concerned, but the consumer, it looks like they're still shopping. Retail sales came in last week about as expected. Healthcare saw a big post up from 40 up to 83.3. Surprisingly, XLF, the financials, are looking more vulnerable. We closed out most of our position that a couple weeks ago, and there were some mixed signals, but we're happy to be on the outside. Another good week for the communications, and of course the utilities. 91, no interest here yet in the XLRE, and XLK is kind of holding that 50 level. So if we're going to see a gross setback, that's where we'd likely to see it. There were some surprises in the sector report. I mentioned energy still looks weak. Materials is It's one I've been toying with. It's trying to turn up. It's at 58.3. So, Sherwin-Williams is a negative on a 1 hour, as is DD and VMC materials stock, but not a lot of new signals showing up at this point. Industrials were a little surprising. The relative performance chart looks pretty sickly. It's now made a new low. That's a surprise. Okay, that's also reflected in the poor relative performance of the Dow versus, say, the New York Composite or the S&P. So, not a lot good here, that I see. CSX, the railroad there, is looking pretty strong. UNP maybe just turning again. So that's about the only bright spot I would see in that group. Consumer discretionary is sharply higher. You can see if you connect a downtrend between these two peaks, we're testing it right now. And so Amazon, a 3DTS, we'll look for that to switch to the weekly too. McDonald's, also quite strong. Booking, Tesla's had a little pullback here, but it looks like it could kick in, as well as the auto parts makers there. So, all in all, pretty good. Consumer staples, trying to bottom on the relative performance chart, but now, at least we know, so we want to see a move above this prior peak. That will indicate a new uptrend in the RS versus the S&P 500, which will be a positive sound. It would also seem to be favored too if the market does correct. Walmart just flashed a daily sell, but there's a lot of ones in here that are buy that I'll be watching for them to flip around. Mondelez here, and Coke, as well as General Mills, and what else do we have? Oh, P&G. CL had just turned positive on Friday. Healthcare, looking pretty good, 83.3. The relative performance chart still doesn't look that great. The other measures of the relative performance do look more positive of that, but I think we get a pullback there, and I'll be looking at that pretty substantial. As I pointed out, I think for subscribers last week, the composite of the healthcare only in the S&P is now only 8%. Last time it was that low was in 2011, 2012 when it broke out to the upside and moved up to about doubled. Quite a run in that group, and it looks like it could be ready to do it again. So Amgen, Merck, United Healthcare, not quite bold enough to go into that, but Bristol Myers weekly. So looking at some of those, I think is be a good idea on weakness. Financials still look poor. Technology holding its uptrend, but you can see where some, Cisco, flashed across the board negative last week. Microsoft is still positive, daily onward. So, if we start to see some more, more of these 4-hour reds, turn negative on NVIDIA, Broadcom, etc., that would be consistent with a pullback in growth and maybe a better rally in the value. Communications, telephone stocks doing great. Netflix also generated, a 3 DTS. It looks like it's probably ready to move higher again. Utilities, still gangbusters. And surprisingly, there are a lot of utility stocks here that are still red on a daily. So, we have EXC just turned, so it's now we need to see a positive DTS, but all the rest of these are positive. So normally when you see negative from the 4-hour and the daily, then you see those flip back to positive on the 4-hour and then on the daily, and that's usually a pretty good signal, particularly when they're above their quarterly pivot and the weekly and the 3-day are positive. So those are some names I'd be looking at. One last chart from the Forbes article. For those of you who are new viewers, really important measure to look at, is the value versus the growth, or growth versus value, the way this is the IWF. So when this ratio is falling, That means that value stocks like banks and everything, that's what led the way between 2000 and 2007, when the overall stock market entered a bear market, went from bull to bear, and everyone switched out of value and into growth. And that's been the trend since then. Made another new high just recently, and breaking out of these prior highs. It is extended on the upside, and you can see the various pullbacks and growth and stuff. That's why crude oil is a value play. It's lower. Banks have not really done too well. Give you how how rabid the buying got for value at the 2006-2007 era. I think Bank of America hit $65 a share, and then by the the bear market, it dropped to $5. So if we had a pretty good couple of months, we're pulling back on some of our long positions. If we miss 3 or 4% of the upside, we'll be okay. But we think the risk has increased, and not a time to jump in with both feet, but time to book some good profits. If you wanted specific advice on either stocks or ETFs, I'd suggest you go to theviperreport.com and subscribe to either the Viper ETF or the Hot Stocks Report. Only $34.95 a month. Hope you enjoyed the video. See you next week.